A new voice to this conversation as well, one that is very well known to our CNBC audience, and that is the former chair of the FDIC, Sheila Bair, out with a new op-ed called "Over-Reliance on the Fed is Compromising the Future for Millennials." We're going to get to that, Sheila, in just a second. Thank you, by the way, for joining us. Hope everybody you know is doing very well. I want to ask you about the banks. Well, very good. That's the most important thing of all. Are the banks doing well? A lot of concern and a couple weeks ago that this health crisis would turn into a financial crisis and a banking crisis. In your view, is there any indication that could still happen?
Well, we don't know how bad this is going to get, and there will be a lot of losses, I can only assume, for banks. They have tremendous exposure to these various sectors that have been hit hard. And then it's generally, if we slide into a severe recession, which is not improbable, that's going to cause, further losses more broadly. So that's one of the reasons why I've been saying kind of a Johnny One Note on this, that banks really need to conserve their capital, need to suspend dividends and buybacks, get rid of those discretionary bonuses too. Now is the time to hunker down. That's the framework that was in place and is contemplated after Dodd-Frank for dealing with this. We need to keep banks healthy and solvent and continue to lend. I think they'll be helped a lot by the government programs. The Fed facilities certainly are pumping a lot of liquidity into them, so we don't need to worry about them not having access to funds. The Fed will ensure that. But will they have the capital to absorb losses and keep lending? That's really the key question, which is why I've been saying for a long time they need to conserve capital.
And I think this question will dovetail nicely, I hope, into your op-ed about the Federal Reserve, because Sheila, I think you and I spoke 12 years ago when the financial crisis was developing. And, back then, it's hard to believe, but back then the numbers seemed impossible. $1 trillion, $900 billion for stimulus. What are you talking about? Well, now the numbers, it makes then look like a glass of wine, and we're chugging 2 bottles now. I mean, do you believe the Federal Reserve did all it needed to, or more than it needed to?
Yeah. Well, I don't know. I think now's the time. I'm more supportive this time around because this is not there's not the moral hazard issue that we had in 2008, 2009. This is not caused by risk taking on Wall Street. This is caused by a virus. Nonetheless, I think there probably could be a few more restrictions on some of this fund, but overall, no, I think the Fed is doing what it needs to do right now. Unfortunately, this is just how we're set up. Each time, this has been going on for decades now, each time we go into a cycle, we default to the Fed, and I'm not blaming the Fed for that. I'm just saying that's kind of the decision that our government has made. We keep defaulting to the Fed to provide monetary stimulus, to lower interest rates. The kind of stimulus they provide is more loans. So you just keep getting your economy just keeps getting more and more leverage, which we are now. The leverage didn't cause the crisis, but the leverage on the consumer balance sheets, on corporate balance sheets, is making it more difficult to respond to this because with all that debt, we are less resilient. So I do think we need to get off this boom and bust cycle of every time there's a problem, we turn to the Fed to juice the economy with low interest rates and inserting massive amounts of liquidity into Wall Street. It just doesn't work. It doesn't filter down to the real economy. And so, once we get beyond this,
Sheila,
we need to rethink that.
No, your word, I think, is very well taken. We have over-financialized our economy. That word you use in quotes in your op-ed, meaning that we've sort of trained an entire generation. By the way, not just a generation, the biggest generation in American history by probably 12 to 15 million more than the baby boomers. We've trained a generation that is coming of age now, starting to have families, get into prime working age, that sort of, A, low rates can solve everything, B, they have no future without debt.
Yeah, exactly. And it doesn't have to be that way. It didn't used to be that way. And hopefully we can get back to a situation where our economy is driven by creation of real value, and the financial system plays a supporting role, not a central role, which is what it's really the dominant role. He said this is going on for 2 or 3 decades now. So I do hope maybe if there's a silver lining around this, we'll be fundamentally rethinking how we drive economic growth going forward. We need to get rid of this debt culture, think about real value, and equity. There's nothing wrong with equity financing. You know, there's nothing, especially if you're a corporation. That's a heck of a lot, or a bank. It's a heck of a lot more resilient than loading up with debt. So I think there are ramifications for the financial markets as well. But I hope that's a longer term debate we can have.